With that, welcome to the business webinar program presented by Bank of America. Today's session is Kickstart Your Tax Prep, and we will learn about types of taxes that might impact your business, potential savings opportunities, and how taxes fit into your plans, including growth and retirement. So lots of important things to cover today. All right. So I am Desiree Brown, Senior Manager of Digital Content and Education here at the Tory Burch Foundation. And I'm very excited to welcome back Ramona Cedeño. And Ramona is a CPA, CFP, in addition to being CEO and founder of FiBrick, a leading accounting firm servicing technology startups and small businesses. And as the CEO of FiBrick, she is dedicated to empowering small businesses with robust financial strategies. This is Ramona's third time joining us. And so we always love to be able to have people back to continue to share their incredible knowledge with our community. And so after her presentation, we will have plenty of time for Q&A. So be sure to ask your questions in the Q&A box, and we'll get to as many as we can. The more general introductions, connecting with each other, that should be reserved for the chat box. And we know how much our community loves to connect and say what resonates with them, all those kinds of great things. And we welcome that. We welcome that community building. Please take notes. We invite you to get your pen, paper, open a separate app if you need to make sure that you don't miss anything. But of course, today's session will be recorded. And so please watch your inboxes for the replay link. And with that, I'm going to turn it over to you, Ramona. Let's get started. Thank you.
Thank you. No, thank you, Desiree and Ali, for organizing this event. I love the content that you bring to the community and the sound of being back for the third time. That was so good to hear. I was wondering, was it 2? Was it 3? So this is very good. Thank you again. And thank you to your sponsors, of course. Let me start by sharing my screen and let's kick this off. Very excited to be here and talk about taxes, as always. You know, this is one of my favorite topics besides money. Hello, everyone, and welcome again. And thank you for taking the time to attend this session and to learn something new or get a refresher on something that's so important to the success of your business. And as Desiree mentioned, add your questions to the chat. I'll be happy to answer as many as I can at the end, and I will try to leave enough time for that, because with all this content, it's hard sometimes to condense it all in 1 hour or 45 minutes, but I'll do my best. And if there are any follow-up questions after the event, you can always send me a message on LinkedIn or Instagram. And if it's not something that is advised, I'll be happy to reply to you. The session today is Kickstarting Your Tax Prep. And when Desiree and I were planning this event, we were talking about how important it is to have this type of information during the year, rather than having it at the end of the year or in January or February, when everyone is so stressed out about what did I miss during the year. So I'm glad we are able to fit this in during the summer, and hopefully you get a lot of valuable information. I have to say, this is not on the slides, but we do not consider this information alone as tax advice. This is guidance. You are encouraged, or we recommend that you contact your tax advisor with questions, that you do your own research and then validate it with the proper resources and sources, so that you are making the decision from a comprehensive information perspective, not just from a few lines or a few comments that I make today about a particular issue. I'm a CPA and certified financial planner and the founder of FiBrick. FiBrick has been around 9 years. Super excited to get to the 10th year anniversary next year. And hopefully some of you can make it to I'll probably do a party. So hopefully we can all meet there. I have been in the industry 20 years, working for different organizations before starting FiBrick. And at FiBrick, we help small business owners, startups, and the small business community in general when it comes to everything related to taxes, finances, accounting, money. I'm so passionate about empowering the owners, the employees, the stakeholders of a business at the financial level. And we can use our businesses to do that for ourselves, for our staff, for our clients. And that's my goal. And that's why I wrote Simple Choices, Big Rewards, Big Money, which is a book where I tell my stories on how I manage my money, save money, make more. And you can find story of my life, a little bit of it in that book if you check it out. Let's get started with today's session. I wanted to share some statistics about the importance of this type of content information and compliance requirements that we have for businesses. According to the National Small Business Association Small Business Taxation Survey, small business owners spend around 10 hours a week managing tax-related tasks. And this sounds like a lot, and you'll be surprised. It does add up, and you might say to yourself, I don't do anything related to taxes. I have an accountant, they do this for me. But if you're replying or responding to a notice, if you're replying to requests from your tax accountant and you have to spend time organizing it, all that adds up. And when you average it, most businesses are spending about 10%, 10 hours a week on these tasks. And the other statistic that I have for you here is that according to SCORE, around 60% of small businesses miss out on significant tax deductions and credits, causing them penalties and missed tax saving opportunities. And the way this happens a lot of time is because we're not aware of what we can deduct, take a credit, or we're not preparing ourselves timely. And by the time tax filing comes in, we don't have the data, we don't have the information that would allow us to take advantage of these tax saving opportunities, or we make decisions that cost us money. And according to the national, this is not the federal SBA, this is the National Small Business Association, which is a separate association, not the federal one. 59% of small business owners say that federal taxes are one of the most significant burdens of their business or on their businesses. That's not surprising. I hear every day, I pay so much in taxes. How am I going to pay this? And the significance of these statistics is that we want to be able to reduce that burden. And the way you do that is by maximizing your time, not spending it on taxes, on tax-related tasks, because that's money too, right? Cost opportunity. And reducing the tax liability within the laws by taking advantage of all the credits and deductions that we have available to us. And in the chat, I would like for you to tell me if you typically plan for taxes throughout the year. And if you don't know what that is, what is planning for taxes? You can say that. But what I'm looking for here is a yes or no. And you can add, no, I hate taxes. I don't want to have anything to do with them. No, I have no time. You can add that. Or yes, I wake up every morning just ready to work on my taxes. I have a CPA friend that I talk to on a regular basis, and he told me yesterday, I did my taxes. And I'm like, you did? For your business and personal? That's very good. I have an extension, but I have an excuse, okay? Don't follow me. I have a good excuse to file an extension. But please comment on the chat. I would love to see what you have to say about this. And I'm going to see the chat comments later at the end of the event. So today I'm going to give you 10 tax planning strategies for your business. And these are the ones that I have identified as of this year, this session, and most of these are permanent. So if you are watching this a few months later, or even in the following years, most of these strategies are evergreen. And if there is anything that is temporary, I would mention that. In addition to this, there might be others that apply to specific businesses, specific industries. So that's something important also to note, that if you are in entertainment, if you are in restaurant, if you are in education, there might be some tax opportunities, sometimes locally at the state level, sometimes federal level, that you may want to also look into. The first strategy that I want to remind you of is optimizing your entity structure. And many of you may have heard of, an LLC, S Corp, C Corp, and why are these important in the context of this presentation? The reason I believe this is one of the top strategies is that the way each one of these entities is taxed varies. And the way the entity is going to impact you at the personal finance level and at the tax level would depend on your goals and the goals that you have for the business, but also the goals that you have personally. And I'll give you a few examples. If you have a C Corp, or if you're considering setting up a C Corp, the C Corp is taxed separate from the owner. It's its own taxpayer. It pays a flat 21% in taxes to the federal tax agency. And then the income from that C Corp doesn't flow through into your personal return. A lot of people believe that it's a double taxation entity. That's how it's known, because after you pay that 21% at the C Corp level, if you take a distribution from that C Corp, you're paying taxes again at the personal level. However, if your goal is to take the C Corp to a scaling phase where you're going to get fundraising from investors in exchange for equity, maybe most investors would want you to be a C Corp. So if that's the goal, then that might be the strategy or the entity structure for you. However, if you're thinking of working you're going to self-fund, you have a small business that is going to be your family-owned business, and you want to maximize the taxes, maybe an S Corp or a single member LLC or a partnership is the way to go. And each of them have different advantages. Some have disadvantages, and understanding those plus what your family and your personal goals are financially, it's important. I never recommend to say, go with the C Corp because it's a flat rate, or go with the LLC because you're filing one single return. The LLC with your personal return is one, it's simple. I wouldn't recommend just to do that without taking into account other factors. And speaking of LLC, sometimes what I hear from some of my clients is, if I have an LLC and the LLC files a Schedule C within my family, my joint return, my husband or my wife is going to see the money that comes in and out of my business, and I'm not ready for that. So that sometimes is a reason not to select one of the specific tax entity. So this is why, again, it's important that you consider the long-term vision for the business and for you, in conjunction with what is the best structure from a tax perspective. And once you decide on that, before you make the change, also understand what are the tax reporting requirements for the entity that you are about to choose or to be taxed as. And to expand on that, if you are an S Corp, for example, you have to be on payroll as the owner. So you have to set up payroll for yourself within an S Corp. The LLC doesn't require you to be on payroll. So that sometimes is a surprise to a lot of business owners, because it's that I don't want to pay myself. I don't want to be on payroll just to be just to be an S Corp. But that alone cannot be the decision-making factor either. I see that I have a message here. I'm going to try to close that. Great. Strategy number 2, and jump to 3. I'll go back. Strategy number 2, master financial data organization. This is a recurring observation and recommendation that I will make, and that most accountants and bookkeepers will probably remind you of. And it comes down to understanding and having visibility into how your business is doing, and also making sure of having this comfort level that your business's financials are complete and accurate. If you don't have that certainty, it's going to be hard for you to answer the question of, what are my estimated tax payments for this year? Or how is my business really doing? Am I going to have enough money to cover the taxes? All of these questions are better answered when you have organized financial information. So although this is in theory, you may think that it's not directly related to taxes, it is, because not having organized tax or financial data can result in you excluding some expenses or including some expenses that we should not, having income classified incorrectly. Sometimes I see that an owner takes a distribution from their company and they record it as an expense, but that's not an expense depending on the entity type that you have. So organizing your bookkeeping information using the right tool to do this. Sometimes you might be hesitant to set up a tool like QuickBooks or Wave apps or Xero, and there are many options. And if you're looking for the cost-effective one, there's options for that too. And we always look for the best, right? The most cost-effective one. But it's important that you choose something, that you choose one bookkeeping tool to manage your accounting or your bookkeeping. It doesn't always have to be a software. I don't love when we track income and expenses in Excel, but if you have a low volume business in terms of transactions and you're starting out and you want to start in Excel, I'm not going to say definitely don't do it. It's not ideal, but some clients do, or some business owners do use Excel and they can manage it well. The importance of using an accounting software is that you can create, through the system, you can create your business balance sheet. And having a P&L, profit and loss, or income statement, it's all the same. That shows your revenue and your expenses, and it shows accurately what the business has done in those areas. It's critical, but also so is your balance sheet. The balance sheet will show how much cash you have, how much you have in loans, if you contributing money to the business, and it's a contribution. And I get this question a lot of times. I put money in, is that income, or that's the contribution, or maybe it's a loan. If it's a contribution or a loan, it will be on their balance sheet. And when you don't have an accounting system or process that's tracking this on a cumulative basis, it's very easy to get things mixed up. And consistency is key. I recommend that our clients and all business owners reconcile their bank accounts on a monthly basis. And this applies also to your billing your customers, because this is important. It's going to impact the timing of your revenue, the availability of cash to cover those taxes, right? So everything that happens in your business from a financial and even operational perspective, at the end of the day, impacts your profits or your loss, and it impacts your taxes. Strategy number 3, I want to hear on the chat, how many times have you heard this? Or at least say, if you have someone tell you this, if you have heard someone tell you this in the past or not, and it's separating your personal and business finances. Anytime I talk about bookkeeping or taxes, I remind everyone about this. And this impacts your taxes, because if you have personal transaction in your business finances, you're either overstating income, if you have personal income that went in there. That case I don't see a lot. But you might be overstating expenses because you have personal expenses that you classified as business. And it might seem like an innocent mistake, and sometimes it is, but in the case of an audit, this comes up, you would be disallow the deduction because it was a personal expense, and then you have to pay the penalty for the excess deduction for past years. So it's important to separate the two. And the other scenario can happen where you are paying for business expenses with your personal funds, and this is sitting in your personal bank account, all these charges for a subscription to DocuSign or Adobe, and you forget to transfer that expense into the business, and now you're missing out on that deduction. So that causes your net income to be higher than it should be. So the best way to make this happen is to have separate bank accounts from day one, separate credit cards. Even if you are not able to get a credit card under your business's name, you can get a credit card under your name, but dedicated to the business until you can get the business credit card. It's not ideal, but it's better than just using the same credit cards for personal and business. So separating bank accounts and credit cards. And if you have to fund your business bank account or vice versa, it's best to do a formal transfer of cash. So if your business is short of cash and you want to fund $5,000 worth of expenses, you transfer from your personal bank account $5,000 to the business, pay everything from there, and you record this transaction as a contribution or as a loan when you are doing the bookkeeping for the business. I touched on the tax implications of this. Some of the legal implications have to do with if you are the type of entity that you have, and making sure that if a company has this responsibility to keep clean records, like in the case of a C corp, everything has to be pristine, where there is no gray area between who is the entity. Is it the C corp or is it the business? Is it the person on the business? So a corporation has to have separate records and accurate records, and it's important that that is shown in its financial transactions, contracts. All of those areas need to be under the business's name. Business has control of bank accounts and credit cards, and not that there is movement between the owner or the shareholder and the entity. I hope you're getting all your questions ready. As I'm going, just put your questions in the chat, and then Desiree at the end will come back and tell us and ask a few of them. Strategy 4, understand business tax deductions and credits. And believe it or not, I do get the question from clients, which I love all questions from my clients. I'm here to help them. That's why they hire me. One of the questions is, what can I deduct from my business? And to me, it's very simple, but not to the rest of to everyone in the business community. So the answer to that question is, the IRS defines business expenses that can be deducted as expenses that are ordinary and necessary for the course of business. So if your business requires to have rent, then and most businesses, in order to run their operations, have to have an office space, then that's an allowed deduction. But there's so many marketing expenses, insurance, marketing, insurance, payroll, subscriptions, professional dues if it's required for your profession or for marketing and business development. Some tax credits that are available that are common include the R&D credit. That one is very popular among businesses that are in the technology space, but that one is not just for technology. So the R&D credit, what it does is allows you to get a credit on research and development spend that you incurred for your business. And this could be research and development spend for creating a new process, a new technology, or if you're manufacturing a new product, it could be to enhance something that already exists. So the best way to determine if you qualify for this is to hire or engage a tax company that specializes in doing this type of analysis to determine whether you qualify for that credit and what dollar amount qualifies for the credit. And you can get up to 10% of the amount spent in R&D as a credit to offset income taxes or payroll taxes. There is kind of this ideal spend. I don't want to give you a number, but because it costs you to get the R&D study done, you have to assess the cost benefit analysis of like doing the R&D, paying for that, the R&D study, paying for that, and then what is the amount of the credit that I'm getting. So, and also you have to invest your time. So it's important that you know that. There are other credits like startup cost credits that you can, if you're in business for the first time and you incurred costs before the business was established, those costs are not lost. That's a question that I get a lot. I started my business, but I haven't really launched it, and I'm spending all this money to set it up, to hire a marketing person or a developer. Those costs are not lost. You can deduct them. There is a rule, a tax law that rules how or guides how the startup costs can be deducted. So it's important to talk to a tax advisor. Pension plan startup costs. If you set up a pension plan, and I'm jumping here because it's kind of related to the credits. But the pension plan startup costs, what those are, is if you set up a pension plan for your employees for the first time, there is a tax credit available for the first few years of that plan. Bad debt is one that comes up a lot. So if you are on a cash basis, if you report revenue and expenses only based on when cash hits your hands or gets to you, or when you pay your expenses, bad debt doesn't come into play for you. And I get this question sometimes, and the clients will say, oh, my customer didn't pay me, and it was X amount of dollars for that service that I provided to them, and now they're not paying, which is, pause there and say, if you are not getting paid from your customers or by your customers, you need to look at, I suggest that you look at your accounts receivable process, how you bill, the terms that you have in your contract, how you follow up, and if you need to set up a retainer process there or prepayment, that's accounting. It's not necessarily all tax, but I wanted to remind you, if you're not collecting timely, I suggest that you assess your accounts receivable and your billing process. But bad debt, going back to the topic, if you are on a cash basis where you only report cash received when it touches your bank account or when you get a check, and you report the expenses when you pay them, bad debt is not a thing for your business, because that means that the revenue related to that billing never hit your bank, so you never included it in your taxes. But if you're on an accrual basis, and you will know this through talking to your accountant or looking at your tax return, you would be able to use the bad debt write-off as a deduction, because you had already included the revenue in prior months. Charitable contributions, I added this here because charitable contributions made by the business, in most cases, flow through to your personal return. So do not forget to include them. If you're making them through the business, they should be in your account, in your P&L, in your profit and loss statement, and this should be communicated to your tax accountant that I made these contributions, they are in this category, and then they will determine, as they prepare your personal tax return, how to handle them or how they're reported. If it's a corporation, a C Corp, then they're deducted at the corporation level. A new credit or more recent credit is the electric vehicle tax credit. And this is a credit that's available if you buy an electric car and I have it here because some business owners do need a car for business. And if they buy the electric vehicle, they might get the credit at the business level. If you buy it at the personal level, the credit might also be available for you and your personal taxes. There are some income limitations, so it's important to understand what their qualifications are so you can plan accordingly. Because if, let's say, the income limitation, just as an example, is 150,000, meaning that if you can get this credit only if your income is less than 150. You can probably plan for that. If you're borderline, your income is 160 and it's November and your income is 160, you want to maybe spend down 10,000 to get to that 150 so that you can get that vehicle tax credit. That's when the planning is really impactful. It's when you can manage some of those income thresholds to get access to these credits that are based on income. Documentation and compliance. This topic, this bullet here, I put it in here to remind you that all the deductions that you take at the business level and tax credits that you claim, they should be substantiated by proper documentation. You don't have to provide that documentation with the tax return locally. That would be so much work, but you must keep it on files because if you are audited, you want to be able to show proof of the spend and what was the reason for it, how does it relate to the business, and it's important to have all that. We hear sometimes people asking, but the expense is only $25 or $10. Do I need to keep it? I either keep it for all or understand exactly what the threshold is. And sometimes there is, like with the IRS, you might have a guidance that say everything over $25. This is just an example. Everything over $25 requires a receipt. So you need to understand if there is such threshold. And then the other question that I get sometimes is, I have all the expenses on my credit card. Do I still need to keep the receipt? Yes, because when I look at your credit card and I see that you took an Uber, I don't know if that Uber was personal or business. They might, I don't know if you remember the date of the trip, where you went, if it was for business, right? So you want to keep the receipt. It shows the date, compares to the event that you had that day, or matches the event that you had that day if you have a calendar. If it's a restaurant receipt, the guidance will say that you must know who you met with and what was the purpose of the meeting. I'm not gonna know that from looking at the credit card. So if I wasn't an IRS auditor, so what I do and I recommend my clients do is that on the receipt they write down like lunch with X person and business development, or lunch with, I don't know, Mary, and it was for example, it was a trip to for X conference. So just put some type of business reason, or the real business reason, and the person that you work with. And then if you scan that, the note will be there. If you're not scanning receipts because you have a different system, you can then write that in the memo where you're tracking your expenses. I'm not sure why. Desiree, are you able to hear me?
Yes, can hear you with no problem.
Okay, great, because I'm getting a low resource note, so thank you. Okay, let's see. Strategy number 5. If this is going a little fast because I don't see. Okay, great. So strategy number 5 is staying updated on changes to tax laws. There have been so many changes recently, right? We hear the Biden administration is doing this, and Trump, when he was in office in 2018, had a lot of changes, and some of the changes that were implemented in 2018 are about to expire because they were temporary laws. So sometimes the tax law is issued for an indefinite period of time, and sometimes it's for X number of years. So it's important to understand that distinction too. And staying up to date on these changes and what's coming allows you to plan and to make adjustments to your tax strategies. So for example, one of the changes that we had in 2018 was that during COVID, that was 2018, no, during COVID, for example, let me use that one. During COVID, we were allowed to deduct 100% of our meals, business meals. Generally, we can only deduct 50%. So that 100% was in effect only 2 years. And it was to support restaurants, small business, small restaurants. And it expired. So in 2023, we didn't have that anymore. And it could have been shocking to clients if they weren't ready, because when it was 100%, we were like, oh, let's invest more of our business resources in business meals to support business development, but also to support our small restaurants. And once you know that that's not 100% deductible, you might say, okay, I'm not going to spend as much in meals. I'm going to move my resources somewhere else. But if you're not ready for that, you don't make that shift. And the same thing happens if we are expecting that certain income level for getting a credit of a child tax credit or some other tax credit, if the income threshold is going to change in a couple of years or next year, we may adjust certain things. And not knowing this ahead of time, or even asking your tax advisor or the advisor telling you, it might result in missed opportunities for planning to take advantage of those deductions and credits that you can either accelerate to this year if that's possible, or move to next year. So always do some reading or listen to some reliable sources of news, but you can double check information on the IRS website. And if you hear something on social media or you get a blog from someone, you can always search that up directly on the tax agency's website. It might be something related from your state. In New York, let's say New York State has a new tax law that was just passed, or it's coming up and you hear of it through a friend, you can always go to the tax day website and you'll find a lot of updates there. And the same thing with the IRS. And based on what you know, reassess whether your tax planning that you are going to be doing now. And when you hear tax planning, it doesn't mean like I have to figure out how much I'm going to invest in an opportunity in a zone vehicle. It's more like being aware, what are my options? What should I be considering now? Now let me talk to my tax advisor. And if you're doing your taxes on your own for your business and personal, you can always try to find an advisor that would kind of give you a second opinion of what you are thinking of doing or the approach that you're taking. And not everyone will do that, but I'm sure you might be able to find one out there. Okay, strategy 6, maximizing retirement contributions. And I say maximizing because that's what we want to aim for, at putting the max there, but it's really anything that you can contribute to a retirement plan. It's great. The more, the better, in my personal opinion. But if you have a small business, you have a few options for setting up retirement plans. There is SEP. A SEP is going to be where the company is making 100% of the contributions. So if you want to contribute 10% of the business income, it's just the business that's making the contribution. And this plan, because it's the business making the contributions, and because if you make the contributions for yourself, you may have to do it for all of your employees, is one that needs to be evaluated and set up properly. There are some exclusions that you might be able to make in terms of how long the employees have been there and whether they're part-time. This is something that needs to be discussed with the financial advisor. What is the right plan for you if you have employees, especially if you have employees, and depending on how long you have been in business. The business makes all the contributions. With the 401k, the employee makes the contributions through payroll withholdings, and the business can make a match contribution. And that also is defined by the plan that you set up. And then with the simple, it could be the business or the employee, but the simple is the one that allows the lowest amount of contributions. And that's why it's a good option. But if you want to be able to contribute the highest possible amount for yourself, that might not be the best one. Understand the contribution limits and what your goals are, and taking advantage of the tax benefits. This include, if the business is making the contributions, it is a tax deduction for the business. So that means your net income at the business level will be less. The money is put in an investment account, and if everything goes well, as we all wish, the money will grow. And by the time you retire, you have made a lot of money, hopefully. And at that point, you do pay the taxes on the money as you take it out of the plan. But the hope is that your tax bracket at that point is lower. And also you have invested all this money over the years, tax deferred. So it was money that otherwise you have paid, some of it you have paid to the government now, right? So you're putting this money out there to grow for you and saving for your retirement, and it's saving for your retirement, which is another benefit that we have to think about. It's not just the tax benefit, but it's also the fact that it makes us, or it forces us in some way to save for when we retire. And that, I think, is an invaluable benefit. Rather than not doing anything, this is, it's kind of it's a safety net. And strategy 7, implement tax efficient compensation strategy. So this will apply to you if you have, especially if you have employees, and if you have a company a startup that is where you're thinking of growing and getting investors, and you have employees, and you want to retain your employees through employee stock options and other incentives. If the first bullet here, optimizing owners' compensation, this applies to any entity type. And what we're talking about here is, if you are an S Corp, for example, and you have to be on payroll, understanding what salary you need to take based on the IRS guidelines, but what is the ideal midpoint or the compromise that you can make between what I must do versus what the business can do, and how that impacts the taxes and the overall cash flow. And the IRS will say, if you're an S Corp, you need to pay yourself a reasonable compensation as any other employee. But you have some flexibility depending on how the company is doing from the cash flow perspective. And also, what are your goals to reinvest some of the money that the company is bringing in? If you're a C Corp, venture capital funded C Corp, or just a fast growing startup, you may want to implement stock options and other deferred equity compensation to help retain your staff. And some of the tax benefits of doing this include the fact that if you're giving compensation to your employees that are deferred compensation, you are not giving them cash right now, but as the equity is vesting, the business might be able to take a deduction from that. I'm going to move to strategy 8. And this one is so critical, understanding how your small business impacts your personal taxes. At the beginning, I talked to you about different entity types: LLC, partnership, S Corp, C Corp. Knowing how the net income from your business flows through in your personal return is critical, because you also want to plan at the personal level. What is going to be my taxable income when I take my payroll, if you're on payroll, plus my business income? How much am I going to be taxed on? That amount drives what your tax bracket is, right? So we have in the US, we have this tier tax bracket. Some the income pays 10%, then we go to 12, then we go to 20, then we go to 37. You know, there are a few in between. So that where you fall in that tier is going to be based on how much money you make. So how does your business impact this? You can control, to some extent, within the law, the profits of your business in most cases. And how do you do that? By spending, reinvesting, spending in the business, valid expenses that you need for the business. You can accelerate those, and that way reduce your net income. If you're trying to keep your personal taxable income low to manage the tax bracket. Now, that doesn't have to be the strategy that fits every year. You also have to look at other goals and and kind of predict what might happen next year, which is sometimes hard. But to give you some examples, if you, let's say, want to reduce your net income at the business level this year, and you say, I have my expected net income is 100,000, but I really want to bring it down to 75. Let me spend 25 in expenses that I do need anyways, but that I was going to leave for next year. Let me spend 25,000, bring my income down to 75. Then what happens next year? If you have a great year and your income is 300,000, and now you moved some of the income from this year, some of the expenses from this year, you moved it to this year. This is causing this year to be lower, but then next year is going to be higher. So there is a little bit of budgeting and analysis that you have to do to make this decision. So always better, of course, to consult with a professional that can help you. But if it's something not high volume that you can manage yourself, I would just consider, what is the impact on me spending this year or not spending this year, and how does that impact next year, and what are the probability that I'm going to be okay year over year by making this decision today. Estimating your personal tax liability when you have an entity that has income that flows through to your personal return involves taking into account what you're making if you're on payroll, plus what you are getting from the business. If you're not on payroll because you're an LLC, you estimate your personal income taxes using the business's estimated net income. And there are other things to take into account, other deductions that you may have. If you itemize because you have a home with interest, with the mortgage interest, or if you have children and other deductions that you might be taking and credits, you take that into account. But we start with, what is the taxable income from the business? And then my deductions on all the income that I'm making on the stock market, and maybe I'm getting income from other sources. You take all that into account to estimate your personal tax liabilities. And the sooner you do this, the earlier you do this in the year, the better you can plan for cash flow purposes and have time to make the payments and avoid penalties. Strategy number 9, planning for estimated tax payments. This is important because if you don't pay your estimated taxes during the year, you will incur penalties for underpayment. And in some cases, we might be okay with that. But if you want to avoid penalties, we want to make those payments quarterly. Understanding the estimated tax payments for your business is key because in some cases, the business is paying taxes directly to the tax agencies. But in some cases, the business doesn't pay the taxes. You pay on behalf of the business, to call it something. You're paying in your personal return under your social security number. You're paying estimated taxes and full year taxes with the tax return, including the income that came from your business. And an example of that is an LLC, single member LLC, doesn't pay taxes to the IRS. The S Corp net income, if you're on payroll, the net income is going to be after your payroll. That net income pays taxes in your personal tax return. So you're responsible for estimated tax payments. There might be some state and city taxes that these types of entities still have to pay directly to the state agencies. So it's important to understand that. To the IRS, single member LLC and S Corp and partnership don't pay taxes directly. The business owner pays the tax, but the states might have their own taxes that they impose on those entity types. So know that distinction. And it's important to budget for tax payments because having these cash flow surprises can throw any business owner off, right? So you have $100,000 in net income at the end of the year and you haven't made estimated tax payments. You now have to pay $20,000 to the IRS. That's just an example. You didn't plan for that. Then where does that money come from? Sometimes it's a big shocker. So doing the estimated tax calculations throughout the year, making them quarterly as required by the IRS and states will prevent penalties and the surprises at the end of the year. Some business owners like to have a separate bank account to put aside the cash for tax payments. That's a preference. Otherwise, you just know that you might owe X amount and you keep it in your regular tax account. Not tax account, your regular bank account. And strategy number 10, I touched a little bit on this before when I was talking about the accelerating expenses. But strategy number 10 is deferring income and accelerating expenses. And this is deciding whether to defer or not. What this is that if you're on a cash basis, that means that again, you pay taxes on income collected and expenses made, and minus expenses paid. If you are under that method, sometimes business owners are able to delay collecting income from their customers on the last month of the year. So if you're in December and you don't bill your customers, and you don't send them a bill for services provided in the month of December, they are going to pay that in January. That means that you're pushing income to next year just because you delayed the bill a little bit and the client is not going to pay you this year. Making this decision, again, should be done by doing some analysis to determine that, yes, it is the most beneficial option this year, and understanding how it's going to impact next year, because then that income that you didn't collect this year is going to be moved to next year, and next year you're going to be taxed on it. And the same thing goes with expenses. You can spend on those common expenses that we discussed before, spend on that this year, and then that way decrease your net income. But again, you have to evaluate the pros and cons of each of these strategies. And understanding the overall financial goals is important at the personal level too, because if you are decreasing your income within the tax laws, and then you need to apply for a mortgage, or you need to apply for a loan, and the income was low, that will impact the possibility of getting that loan or that mortgage. So it's important to consider how each of these tax strategies impact your personal financial goals too, and the goals of the business. And we are done. How was that? I would love for you to connect with me. We're gonna do Q&A now, but this has been amazing. I hope it wasn't It wasn't, there was some connection issues there, I think, but I hope you got most of it. And if
I
there was,
think we did. Yes, thank you so much, Ramona. So we're going to jump through a couple of questions in the minutes we have left. You touched on this a little bit earlier, but can you reiterate for us, if you need to fund your business with your own cash, what should you do? What is the best way to account for that on your taxes?
oh, on the taxes, it does not impact the
Okay,
net income of the business. You just track it on the side as a loan or a contribution, or if you have an accounting system, it will be tracked there by the category that you select, which is contribution or loan, and then it doesn't impact your net income.
great. Thank you. And then we had this great question from someone who is using a subcontractor in their business. Now, as they're getting paid, do they owe taxes on the money that they will ultimately pay to that subcontractor?
It's very important just to make sure that you have a W-9, a signed W-9 from your subcontractor, so that this is when they're using a subcontractor as a vendor, right?
Yes.
Okay, so if the contractor is your vendor, you are paying this contractor, that's a valid expense. You will deduct it in your P&L, but it's important that you give them a 1099 at the end of the year.
Okay. And on the subject of 1099s, we had someone who asked their early stage founder, they themselves are getting 1099s. Now, how should they think about their taxes? Should they file these separately from their personal taxes?
So if we're receiving a 1099,
Mhm.
if the services is being provided by your business, the 1099 should be issued to the business. And in
Okay.
that case, it's part of the business's overall gross income. If it's being issued to you personally, then you have to include a Schedule C in your personal return for this side freelancing income.
Great. And Ramona, I mean, taxes, we can all prepare ourselves, but it is super complicated. And so, or can be, what do you recommend, or who are the tax professionals or financial professionals that someone should have on their team?
Yeah, so it depends on the size of your business because, of course, we have to take into account cash flow, but a tax advisor or tax planner is always key because there's just so many moving parts. And then the bookkeeping side, it's great to have an accounting firm or bookkeeping firm that can do this for you, but initially you might be able to just get a freelancer that can help you with the bookkeeping. And then maybe your tax accountant can give guidance to you or to the bookkeeper on the best practices. And then as you grow, a fractional CFO might be something that will help you grow and just take your business in the right direction.
Okay. And one last question. Do you have a suggestion for the best low-cost platform for organizing things like receipts and those important income statements and things like that?
Yes, so I believe Wave app is WAVE app. They're pretty good and they have a free version. And if you're gonna do your bookkeeping yourself, you can check that one out. From there, QuickBooks have a few tiers. It has one for self-employed, one is called self-starter. So they have different pricing levels depending on needs. So check those two out. And there are other FreshBooks and Xero. Compare those and see what fits your needs.
Wonderful. Thank you so much for joining us today, Ramona. We really